Last week wasn't just another up and down week in crypto. Not at all. It might have been the week that fundamentally changed the rules of the game. We saw a huge price surge, yeah, but what was going on underneath all that? Well, it looks like three powerful forces all converged at once, and it could reshape the entire future of this market. So let's get into what really happened. So this was the number that just lit up screens everywhere on January 15th. A sudden, powerful surge that had everyone from the most seasoned traders to people just casually watching asking the exact same question. Wait, is this it? Is this the moment we've all been waiting for? But here's the thing. This was so much more than just a number on a chart. This rally, it just felt different. It was like the result of a perfect storm of events, signaling that the very foundation of the crypto market might be shifting, and maybe this time for good. Okay, so here's how we're going to break this all down. First, we'll look at the breakout itself. Then, we'll dive into the three key drivers that really made it possible. We're talking about a major shift in the global economy, a surprising wave of positive regulation, and the undeniable arrival of the big institutional players. And all of this, it leads to one massive question. Are we actually witnessing the end of crypto's famous 4-year cycle?
All right, so first things first, let's just look at the numbers. What exactly did the market do that got everyone so excited?
What's really fascinating here is that this wasn't some market-wide explosion where everything went green. Nope. Bitcoin and Ethereum, they absolutely led the charge with some really impressive gains. But then you look at Solana and XRP, and they're much flatter. This tells us it wasn't a broad, retail-driven altcoin frenzy. It was a really concentrated move. So what made this particular rally so different? And here it is. This is the crucial difference. The on-chain data, the public ledger of all the transactions, it shows us who was buying. In the past, these rallies were often fueled by retail traders making these super high-risk, high-leverage bets. It's kind of like building a house of cards that could just collapse at any moment. But this time, we saw the whales, the big, large-scale investors, buying and holding the actual asset. That's like building a solid bricks, creating a foundation for a much more durable, sustainable uptrend. So if it wasn't just retail hype, what was the fuel for this fire? Well, the first major driver is something you might not expect. In fact, it was a seemingly boring government report that actually acted as one of the biggest catalysts of the week. So on January 13th, the US dropped its latest inflation data. And while the numbers themselves weren't totally shocking, the main takeaway was crystal clear. Inflation is continuing to cool down. For a market that had basically been holding its breath, this was a massive green light. And here's why that matters so much. See, cooling inflation basically gives the U.S. Federal Reserve the go-ahead to start cutting interest rates. And when rates are low, money flows out of those safe, low-yield savings accounts and into riskier, high-growth assets. And in today's world, that means a pretty big chunk of that capital is going to be looking for a home in crypto. This macro shift really provided the jet fuel for the rally. But it wasn't just the economy. The second major force at play was this dramatic and honestly surprisingly positive shift in the regulatory world, not just in one country, but all around the globe. We seem to be seeing this fundamental pivot from a decade of enforcement to a new focus on actually fostering innovation. And just look at the timing here. This wasn't a slow trickle of news, it was a flood. All of this happened within just a few days last week. You've got South Korea, Dubai, and the United States all making moves that signal a much more welcoming and clear stance on digital assets. Let's break down what these changes actually mean for the market. Okay, so in the US, the big news was the progress on something called the Clarity Act. For years, probably the single biggest barrier holding back big money from really entering the crypto space has been regulatory uncertainty. Well, this landmark bill aims to finally create clear rules of the road. The fact that it's gaining support from both sides of the aisle is a huge signal to institutional investors that it might finally be safe to get in the game. Meanwhile, halfway across the world, South Korea did a complete 180 on its policy. After a 9-year ban, it's now allowing corporations to invest in crypto. And this isn't just a simple policy change, it's a strategic move. They want to modernize their capital markets and, crucially, stop the massive flow of money that's been leaving the country in search of crypto opportunities elsewhere. And this trend is absolutely global. You've got Dubai giving licensed firms more responsibility, and Hong Kong is adopting international banking standards for crypto. Now, individually, these are important steps, but when you put them all together, they paint a very clear picture of a coordinated global shift towards a more mature, regulated, and integrated digital asset market.
And all of this regulatory clarity leads us directly to our third major driver, the arrival of institutional capital. For years, the crypto world has been talking about the smart money coming. Well, last week provided some of the clearest evidence yet that it's no longer a prediction. It's happening right now.
And hey, it's not just crypto insiders who are saying this. The World Economic Forum points out that we're moving past the experimental phase. Blockchain isn't just some niche technology for speculative apps anymore. It's actually becoming the foundational plumbing for a whole new kind of global financial market.
And we can see the building blocks of this new infrastructure being laid in real time. Just last week, we saw fresh capital pouring into the US spot Bitcoin ETFs. A major crypto custodian, BitGo, filed for a $201 million IPO, which signals huge demand for regulated storage solutions. And then you have financial giants like JP Morgan and Citi now actively building tokenization services. This is the institutional on-ramp being built right before our eyes.
So what happens when you combine a favorable macro environment, growing regulatory clarity, and the arrival of real institutional infrastructure? Well, you get a market that looks and behaves completely differently than ever before. And that leads us to a really profound conclusion. The old crypto market cycle, with its wild booms and devastating busts, it might just be over.
And hey, don't just take my word for it. Major asset manager Grayscale put it this bluntly in their 2026 outlook. They believe the market is entering a completely new phase, one that no longer follows that old, predictable rhythm.
The old cycle was a total roller coaster, right? It was driven by retail-fueled hype, tied to Bitcoin's halving events, and it gave us those absolutely insane, parabolic price spikes that made all the headlines. This new era, though, looks completely different. It seems to be driven by the steady, patient accumulation of institutional capital. As Grayscale points out, even in this recent rally, the gains were much more measured, about 240% year over year, not the 1,000% surges of the past. This looks like a market built on conviction, not just speculation.
And all of this leaves us with the big, unanswered question. With the smart money here to stay and the wild speculative cycles of the past potentially behind us, what is going to drive the future of digital money? As the market shifts from hype and scarcity to actual utility and integration, well, the next chapter in the story is really just beginning to be written. Thanks so much for joining me for this deep dive. If you want to keep up with the ever-changing world of digital assets, be sure to find us over on YouTube at WiserLab. We'll see you next time.